The only thing certain in life are death and taxes. This is your 2021 stock tax guide with how stocks relate to taxes, how to minimize your taxes. I'm also going to be sharing what the guidelines are for 2020, which is due really soon. I'm going to tell you what the due dates are and give you an idea of how much you're probably going to be on the hook for based on your stock market purchases, your selling, and most importantly, what you can do for 2021, so right now, to minimize your taxes moving forward. I'm going to be sharing what I've learned and how it's affected my investing strategy. So it's actually a big reason and it's a big point in how I actually operate day to day with my portfolio. So today we had an amazing day and I am not going to be taxed on this. I'm going to be sharing with you how I get taxed around 1%. And this is really important because I'm actually going to be sharing at the end of this how you can save a ton of taxes with a really cool kind of like hack that automatically lowers your tax bill without you doing anything on your side. So it's really cool. I'll show you what that is. So first off, you should probably know what I'm going to share is not how to cheat the system. All right. This is how to use the system to its fullest capacity. You have the right to do that to make all the benefits for yourself and leverage all the rules as possible. I'm not a CPA and I've spent a ton of time looking at these things because I want to make sure that my portfolio does not get negatively affected by having to pay crazy taxes. So the reason why I'm hidden in this video is so I can share everything and be super transparent as possible without feeling weird. Make sure to subscribe if you want more videos like this. I would really appreciate even just a comment or a like. It's really cool to see you guys watching. I just want to help out. So let's get to it. My goal is to give you as much valuable info as possible. And a lot of times it's more exciting to talk about like how to make all this money, but how to keep it is just as important. So share this if you want other people to see this content that might save them hundreds, thousands, or in my case, it saved me around $100,000 plus knowing what to do here. So let's kind of go through it, some important kind of baselines for your education to understand how taxes work. Now, this is the typical tax bracket. This is for 2020, which by the way is due in May of 2021. That's not necessarily your state taxes, but your federal taxes are due here, or you can file an extension. So that way the taxes are due October 2021, but you still have to pay the amount in May. So whatever your estimated amount is, even if you file extension, you got to pay it in May. All right, so let's get to it. So the capital gains versus ordinary income tax is a very important idea. So you get taxed at different levels based on your income. So you probably know that, right? The more income you make, the more you're going to be taxed. But there's actually two different kinds of brackets. So here's one bracket, which is ordinary income tax. And the second bracket is capital gains or long-term capital gains income tax. So that's something that's really, really important. Now, it doesn't mean, by the way, if you start making, let's say, $518,000 in $518,401 or more, you're getting taxed at this rate. What it means is only for the money above this do you get taxed at this rate. For any amount under it, you're going to actually get taxed at those lower rates. So that's something a lot of people don't really understand, right? So if you, let's say, make 100K and you live in New York and you make 100K, if we go back to our brackets, you might think, oh, okay, I'm going to be in this range, right? I'm going to be in the 24% range. The thing is, yeah, you're in the 24% tax bracket. That's your marginal rate for any money you make above that, but your actual overall rate is going to average to around 15%. And that's because, again, remember, you're paying for 40,000 to 85,000. That money in between, you're paying it at 22%. For the money under 40K, above 10K, you're paying that at 12%. So that's something important to know. It's not like I've heard people go, oh, I don't want to make more because then I'm going to be taxed more. That doesn't make sense. Your taxes aren't going to, you're never going to lose money by making more money. All right. So what I want to make sure we do is we avoid paying this kind of taxes, okay? These kinds of ordinary taxes, because it's the highest tax type of tax you can have. What we want to get into is a long-term capital gains tax. Keyword is long-term, okay? A lot of people say capital gains, and capital gains is when you sell any asset that is more than you paid for it and it has to be a capital asset, which is things like stocks, bonds, real estate, precious metals, things like that. The tax you pay on the capital gain depends not just on how much you make, but how long you hold that asset for. That's why we want to hold it for longer. Long-term capital gains is what we want. We don't want short-term capital gains. Short-term capital gains is essentially this same tax brackets. So we want long-term. Now, this is important because when you're selling anything, you can save a ton by just holding it a little bit longer. If you sell 1 year or less, you're going to be charged at this tax rate. If you want to be charged at a better tax rate, you have to hold it for over 1 year. So if you hold Tesla for over a year, let's say, and sell it, you don't get taxed at this. Instead, you get taxed at this rate, which is way better. These are long-term capital gains. If you're single, the 0% all the way up to 40K. Okay, so you get 0%. So you sell your Tesla and you're making under 40K, you don't owe any tax. And then it goes to 15% and 20%. 20% is way better than 37%, right? So it's almost half. You could think of capital gains as, hey, you owe half as much tax as you probably would have, something around that. So if I was a day trader, I would really carefully understand that if you're a day trader, you have to outperform long-term positions and outperform them by 20 or more percent. Otherwise, you're actually losing money. And the other thing is I'm going to have to come up with the actual cash. So instead of leaving my Tesla stock where it is and letting it basically reinvest and watching it just grow, if I sold the Tesla stock, not only would I owe, in my case, hundreds of thousands of dollars if I took it out of the market, I would also be taking it out of the compounding potential. And if I wanted to put it back in, I should only put back in what I didn't owe in taxes. So let's say I made a 100K profit, and then instead of long-term capital gains, I sold it before a year. And let's say I was in this bracket, so it added 35% in taxes. Well, guess what? Then I only have 65K left of what should be money I can reinvest in, because I'm going to have to pay the other 35K in taxes if I made 100K in profit. So then I can only put back, if I wanted to, 65K into Tesla instead of keeping the 100K in it. So hopefully you see my point here. That is a big thing you should think about if you're thinking about selling or day trading. One note here, the Biden tax plan is planning to up the capital gains to 39.6%. That's a big difference. And the reason why it's 39.6 is he's thinking of actually bumping up the ordinary income from 37 at the top to that 39.6, and then just saying, look, capital gains is the same as ordinary income. So Secretary Janet Yellen told the Senate that capital gains taxes was a long-term goal of the Biden administration. This could cause a potential sell-off, right? As people want to lock in those long-term capital gains at that long-term capital gains rate before this happens. But also, in my opinion, this kind of minimizes the value of people to hold for the long term, which is a little bit of an injustice to investors, because holding for the long term is what is really better for almost everyone's portfolio. We'll see if this comes to fruition. So that's what happens if you buy and sell stocks, right? You're going to have to either pay ordinary income or you're going to have to pay the capital gains. So there's another kind of income you can make. In the Schwab account, it calls it investment income. This is income from dividends. So for 2021, from my dividend stocks, we're at 40,000 in income. I could be at much higher. I made a video on this. Watch that if you're thinking, oh, dividends sound like that's just free money. It's important to understand why a lot of people are kind of misunderstand dividend stocks. Now, most of the time, these kinds of dividends are going to fall into long-term capital gains rates, which is good. That's called a qualified dividend. So if there's a US stock that gives a dividend, it'll probably qualify as long as you've held it long enough. So how long do you have to hold these dividend stocks? It's not like a year, it's something different. It's a kind of confusing, but I'll try to break it down here. You must have held shares of stock for at least 61 days out of the 121-day period that begins 60 days before the dividend date. What does that mean? So you have to hold it for 61 days between the 60-day before the dividend and the 60-day after the dividend period. So you got to hold it for around 61 days or more in that period of 60 days before and 60 days after that dividend date. Other income like interest, so this right here, this interest right here, which is just really low, but if you have a high yield savings account or something like that, the interest is actually going to be taxed at ordinary income, not at long-term capital gains, no matter how long you have had money in that bank account. So I'll leave you with one thing that's, I think, really cool when it comes to saving cash. I haven't been using this enough, but I'm going to accelerate how much I'm using this. It's a really cool automated system to do it. Just like selling at a profit is a capital gain, selling at a loss is called a capital loss. So any capital loss that you have, you can use that to cancel out any capital gains so you don't owe taxes on that amount. So if you have 10K of capital gains and 10K of capital losses, you owe $0, all right? So this is where tax loss harvesting comes in. Let's say I own VOO. VOO is one of my favorite ETFs. It mirrors the S&P 500. So if it goes down by, say, 10K, and I bought and it goes down by 10K, I can sell it and take that 10K loss. And I can right away go buy pretty much the identical ETF owned by Schwab. I can buy the SWPPX, which mirrors the S&P 500 as well. And what this is going to allow me to do is the government will allow me to buy this ETF and take the loss for the last ETF. Now, you can't do this with every stock. So you can't just go and buy Tesla and sell Tesla and then buy it again and take that loss. It has to be a different stock or a different ETF. This is different. And so here we go. We can buy pretty much the exact same fund. It's going to perform almost identical, but the government will allow me to take the loss to count towards that year when I got the loss. I'm basically locking in a loss to offset any capital gains without actually losing in any position because I still have the same position. And if we look at the graphs, they're almost identical performance. They should be performing as close to the S&P 500 as possible. So how do you automate this? Well, that's where the Schwab Intelligent Portfolio comes in. Intelligent portfolios are robo-advisors that allow you to set an allocation of stocks, of bonds, of gold if you want, and it creates an ideal mix of different asset classes. And it buys and sells for me automatically. Now, this is not meant to buy and sell actively to take advantage of the stock. It's meant to keep an allocation percentage. The point of this, though, is I have tax loss harvesting turned on. So what that means is if I go over here to my activity, right here you can see that it's automatically selling stuff. And it's selling things to buy the identical asset in a different ETF. And it's doing this to lock in my losses so I can pay less. Here we go, VOO was sold. This is the S&P 500, and instead it goes and buys Schwab's version because it took that VOO that was sold and then it locks in the loss and buys pretty much the identical allocation. You can see here, this is my US large company stocks. It's actually buying SCHX, which is a large cap ETF, very, very similar to the S&P 500 VOO. And this is what it buys and sells back and forth so that it can lock in tax loss harvesting and still have the same or almost identical allocation of US large company stocks, locking in a loss without actually losing money because we don't want to lose money, right? So instead, we're using tax loss harvesting to just lock in that loss that we can write off. So this is something that I am keeping money in just for tax loss harvesting. And it's actually a really amazing way to automate your stock investing and just not have to think about it. Because what I do is I have it automatically debit a certain amount of money out of my bank account every month, no matter what. I don't think about it. This thing grows. This thing started at 10K. Now it's at 208K. It's just taking money from my bank account every month. I don't think about it. It buys the assets. It sells for tax loss harvesting. Thanks guys for watching. Like this video, I would really appreciate it. Let me know what you think in a comment below. Let me know if you want me talking more about taxes or more about the intelligent portfolio or more about specific stocks. Let me know what you think. I'd love to hear from you. Talk to you soon.